Welcome to The Drilldown, in-depth answers to oilfield questions. I'm John Spears.
And I'm Richard Spears.
Rich. So we're at an interesting point in time. This is the fourth week in October. So a couple of events are just ahead of us and that I think are going to might have a big bearing on next year. So, the Q3 earnings season is fast approaching. We're going to hear in the early days of November about how oil companies did with regard to revenues and profits and capital spending and all that kind of thing.
Yeah, so third quarter numbers are coming out.
Yeah.
And then that tees up how the fourth quarter
is going to go. Yeah, but I think with these earnings reports that managements will probably begin to give some hint as to how much change they expect to see in their capital spending programs next year. So that's really what I want to think is in the minds of so many folks in the oil patch right now is, boy, what's activity going to look like? What is spending going to look like next year?
And who do you have to convince to take that action? Because up until now, we've just spent the last year and a half or two with the oil companies having a very clear signal from their shareholders saying, pay off debt, return money to shareholders.
Yes.
And thirdly, go drill a well every once in a while.
Right. So I think, you go through the exercise, what would you see as are the elements that an oil company, considers as they're putting together a capital spending plan for next year?
First and foremost, you're going to say, what is our outlook for the price of oil or for gas?
Right.
First on the list, and then how much buffer am I going to give myself? Like, for example, it's at $80-something a barrel today, but do I believe that?
Right. This future strip, for example, is closer to 77 next year, right?
It's a crazy high number relative to where it was.
Yes.
So am I, the board of directors, going to tell my management team,
I
know it says 77 or it says 83 or whatever the number is, but I need you to behave as if it's 60.
Yeah. So, pick a number, right? Yeah. And then pick a volume number. Here's what we think we're going to produce. And then all that's going to then say, here's what our expected revenues are, right?
Yep. So that's the number I've got to, that's my total number.
Yeah.
From which then I pay back debt.
Well, pay all your expenses, pay back debt. Yeah. Sure.
And occasionally give a couple of bucks to the shareholders in the form of a dividend.
And that leaves eventually you get down to a big pot of money that's left over. And now what do you do with it, right?
Yeah.
And so how much of that are you going to spend? So this is, besides all these assumptions and that operators have to make and so forth, all price, volume, so forth, they actually have to come up with an argument now because they've got to go to Wall Street and convince folks that they're doing the right thing, that whatever they come up with in terms of capital spending for next year is the right thing to do. And by our lights, as I'm looking at where things are heading, where the trends are, I think it wouldn't be unexpected to see CapEx go up on the order of 35 to 40% next year.
Year over year?
Year over year, yeah.
So if I take the low point in this year versus the high point in next year on a quarterly basis, that could be twice as...
It's 2x, it's twice as high. Yeah, so Q1 of this year, 2021, fourth quarter of next year, easily double, I think.
Yeah.
So but year over year numbers up 35%. So if I walk into I'm an oil company manager.
So you're Conoco or you're Pioneer, you're some publicly traded oil company. You've got investors in New York, Boston.
Hanging on my every word. Yes.
That's right.
And so I walk in and I say, listen, guys, we're going to increase our capital spending by 35%. By the way, I'm not saying those companies are going to do it, but let's say in general.
We're not on the boards of those companies.
So what kind of pushback do you think they're going to have to come up with? Now, in light of the fact that, oil company stocks have been on a tear recently, right? There's a lot of folks who jumping in. I think they see good days ahead. But what kind of pushback do you think that they're going to get? What kind of questions are going to come back from investors?
They're going to look over at the big lending institution to the American oil and gas industry, which is J.P. Morgan.
Okay.
And they're going to go, J.P. Morgan is looking at the current 2021 far better than it was last year, right?
Yes.
And J.P. Morgan has scaled back their lending to the oil and gas industry this year by, 40% or so. They've dropped it.
Yes.
And so in a time when the industry is recovering, when demand is clearly back,
Right.
when we're clearly seeing inventories of oil drop,
Yeah.
JP Morgan is behaving like they had been behaving, which is
Right.
to essentially back slowly out of the industry.
So there's clearly any number of, so this raises an interesting point. So there are any number of equity groups, hedge funds, asset management teams, and so forth, who now have a new rule book that says, don't get anywhere near the fossil fuel industry, right? Climate change issues, right?
Right. Certainly the big institutional investors and the big banks are going, this is a short-term industry, behave as if it's short-term. So lend or invest like short-term.
So, more questions to ask. So what might be the case is you could very well imagine that the guys who are, listening in on that phone call from the senior management team are folks who, they're not with those big institutional investors. They're folks who believe that there is a future for the oil patch, right?
So you wouldn't be running an oil company if you didn't believe in the future of the industry.
Well, I understand the managers that way. I was just saying the investor group. We may see the investors beginning to self-select, right? There are those who are on the outside and going to stay away, and then there are those who are on the inside and they're here, and so there may not be quite as much pushback today as there would have been, say, 12 months ago.
Because the investors who don't like being in hydrocarbons
they're not listening on that phone call because they're not in the
stock anymore.
You're right. Yeah. So, but you did raise an interesting point there about, well, maybe some of the pushback could have been or might be, hey, this isn't a long-term future for the industry. Do things short-term. Don't raise spending and increase CapEx, but just milk it because, hey, everything's going to be gone in just a few years' time, right? So that's one of the other things that I think is hard upon us is that, there's a big climate change conference, I should say, coming up in Scotland. And starts at the end of October, runs for the first couple of weeks in November. And from that, there's all the countries of the world are meeting and agreeing on what they're going to do about climate change and reducing carbon emissions and all the rest, right? So perhaps there will be some concrete policies, concrete steps that will bend that demand curve for oil and gas. We don't see it today, and certainly the policies aren't in place right now.
It's business as usual, really.
Yeah, and some of the
consumer behaves like that,
right? Yeah, and the forecasts that we see based on the policies that are in place in various countries around the world suggest that oil and gas demand is going to continue to grow for the next 10 years, right, or maybe even longer. So, so there is that element, though, of the argument that says, boy, raising capex is a bet on the future of the industry, that there will be demand for this product I'm going to produce going forward. So I could very well imagine that that's part of the discussion that would be taking place around a decision to significantly increase spending.
So if I was the chief executive of a publicly traded oil company, I would go to my investors and I'd say, let's say that you, the investor group who has adopted this policy of the death of the oil and gas industry, of demand. Let's say it's true.
Okay.
And so I will agree with you because you are the shareholder. So this is what we're going to do. Those goals and that decline is 10 or 20 or 50 years into the future. In the meantime, we have a bunch of customers that rely on us for the product that we make. So we've got to supply the customers. Otherwise, we have a huge revolt on our hand, and we have competitors who are going to supply that one way or the other. So therefore, don't we have an obligation to our consumers who've counted on us all these years to continue to supply them with a hydrocarbon? But here's the way we think we should do that for them and to satisfy you guys. Let's just do a bunch of short-term projects. Nothing's more than 3 years. Everything's a short-term project. And so the head of, Conoco, the head of Pioneer, those guys all go in and say, these are short-term projects. So
I think we'll probably hear the word resilient a lot in those kind of discussions, because resiliency, as it pertains to upstream operations anyway, tends to me it's these are low-cost reserves, right? or they are low CO2 emission projects, right?
Oh, yeah.
Or they're short term, right? And they can pay off quickly. So we really don't have to, hang our hat on the notion that there'll still be lots of oil and gas produced 40 years from now. We're just concerned about the next 5-10 years, relatively short term. So we can couch these decisions we're making entirely in the context of maybe it's not so much an obligation, but certainly an opportunity for our company to go, develop this and sell this product, right?
So when they talk about then what are those, what and where are those applications, or where do you drill a well if that's the case?
Right.
Clearly West Texas wins. That one's old school.
Mm-hmm.
If you're natural gas and you're in the United States, it's East Texas, North Louisiana.
Mm-hmm.
But then, a lot of our clients and our colleagues come to us and say, the other short-term projects are those deep water fields.
Yeah.
It's already discovered, it's already developed, but it's halfway developed. And so without going to spend any money looking for the next barrel, you simply put in, some more infrastructure on the ocean floor and milk that reservoir. And those are short-term projects. Those are 2 and 3 year projects. They're not 20.
And they're not $5 billion either.
So that's it's $1 billion. Before that, you get a bunch of billions of dollars of oil out of the ground.
So we're getting close to the end here. Just a couple points that I think we need to think about. And one is that there's a couple of parties that are going to be at this table we haven't talked about or may not be involved in this particular discussion, but certainly listening in. One will be those folks who are sort of those investor types that are on the fence that say, well, maybe I don't have a hard and fast obligation to stay away from fossil fuels. Maybe under some circumstance I might be enticed back in. I think we've seen some of those folks come in. And the question would be if this kind of a discussion as it evolves, if that brings in sort of more of those folks who just want to, dabble, as it were, and catch a few peaks and make some money that way, right? So that's a group that's sort of out there, and I'm sure listening in. The other group, and I think we want to talk about this in our next episode, is what the service industry, the oilfield service industry, is hearing in this discussion, and what will be their decisions about their own businesses come 2022.
Is there an incremental frac spread?
For example, right. And how does the capital spending plan, how would the capital spending plans of oil companies impact the CapEx decisions of the service firms? So we'll talk about that.
That's the next
when
episode.
we reconvene for round 2. So, but before we get there, we have to wrap up this episode, and that's all about the answer to the last puzzler.
Which was maybe 2 weeks ago when we did the podcast. But here was the recap of the question.
Yes.
That our dear friend David Ott had to go he had to go to the grocery store for his wife Pamela, and it's a 2-mile drive.
Yes.
And in the first mile in his Lexus, he drove 15 miles an hour.
Right.
How fast does he have to drive the second mile?
Yes.
For the entire trip to average 30 miles an hour?
Absolutely. So.
And we had, it may have been a record number of people who sent in answers. Some of them wrong, like my original answer was 45 miles an hour, but that's not the right answer. We picked an answer.
We do have picked an answer.
Would you like to read it?
Well, I'll just say that, okay, again, if you drive the first mile in 15 miles an hour, it takes you 4 minutes.
Yep.
Right? If you're going to drive the whole thing at 30 miles an hour, that takes you 2 minutes. So the problem you've got is that second mile has to take negative 2 minutes, right? And so we have...
Well, it has to take... You've already used up all your 4 minutes. You've
used up all your time. Yeah, right. Exactly. Yeah.
So you have to go. Well, let's just read it.
So
the winner of this one is Jeff Lassiter. Jeff, congratulations.
Very good.
And this is his complete answer. He says, so your friend David has a dilemma. Mm-hmm. He has to travel the last mile in 0 minutes. His speed is calculated as distance, 1 mile, divided by time, 0, which is, well, indeterminate. However, in calculus, we can take the limit of 1 over time as time approaches 0, and that is infinity.
Yes.
So he says, I'm afraid instead of David's Lexus, albeit it was an LX 570, a pretty good car, it will not get him there in time, and perhaps next time he will consider an
Infinity, yes. So, which is a very cute but the wrong answer for the
It is
make and
actually
model
the
of the
wrong
car.
car he should
That's
drive.
right. The right car he should be driving is a 1982 DeLorean DMC-12, the very one that comes equipped with a flux capacitor that Doc Brown drove in Back to the Future. So,
Which is the only way he can go
back in time.
back in time. I'm going to go back in time.
Anyway, thanks, Jeff, for that answer and all the other folks who came in too. So we'll be back next week with another episode of The Drill Down. In the meantime, I'm John Spears.
And I'm Richard Spears.